January 14th, 2026, 3:45 p.m. Eastern Standard Time. Yesterday, the United States Mint website looked like a digital ghost town. If you tried to buy a Silver Eagle, the Buy Now button was just gone. Not grayed out, not out of stock, vanished. Same story for the Morgan dollar sets. The product pages were still there. The photos were still there, but the ability to actually exchange dollars for physical silver had been erased from the site like it never existed. No press conference, no official statement, just a leaked email to authorized distributors that I got forwarded around 6 p.m. last night, citing market volatility as the reason for the suspension. That's it. That's all the transparency the sovereign mint of the world's reserve currency felt you deserved. Meanwhile, CNBC ran a segment this morning calling it a temporary technical suspension. Bloomberg's headline read, "Mint pauses sales amid price spike, precautionary move." They're framing this like it's a responsible risk management decision. Like the mint is just being careful because silver went up too fast. Here's what I need you to understand right now. The screen is lying to you. The US Mint didn't stop selling because the price is too high. They stopped because the silver is gone. They can't source the metal. And as of this afternoon, the contagion is already spreading to the private mints. But the US Mint is just the first domino. London is already wobbling. I'm a private commodities analyst. I've been stacking physical silver for 12 years, and I built this channel because I was tired of waiting half a day for the mainstream media to report what I could already see happening in the vault data and the futures chains. You're not here for entertainment. You're here because you want the intel before it becomes consensus, and frankly, before it's too late to act on it. So let me tell you exactly what we're watching unfold in real time. We are witnessing a physical force major event, the institutional mechanism that has been used to suppress silver prices for decades. The paper shorts, the fractional reserve bullion banking system, the futures market magic has finally hit the wall of physical reality. When the sovereign mint of the world's reserve currency stops selling its own coin, the paper price becomes a work of fiction. There's a hierarchy to a supply squeeze, and we need to understand it. At the top, you have sovereign mints. They set the psychological anchor. When they're selling Silver Eagles at spot plus $6, that tells the market everything is fine. There's plenty of metal. When they stop selling entirely, that anchor gets ripped off the ocean floor. Suddenly, the paper price, the number you see on your screen, the spot price that every news channel quotes, that number becomes a suggestion, a polite fiction that has no connection to the price you'll actually pay if you try to walk into a dealer and buy 100 ounces. In this video, I'm going to pull back the curtain on backwardation. I'm going to run the math on the 300 million ounce deficit that everyone in the industry is whispering about, but no one wants to say out loud. I'm going to show you exactly why the 90 spot price you're seeing right now is the biggest lie in finance. By the end of this, you'll understand what's happening at the comics, what's about to happen in London, and what I'm personally doing with my own capital as the exits start getting welded shut. Because here's the reality. This situation is moving faster than the news cycle, and if you wait for Jim Cramer to tell you there's a squeeze, you will be 3 weeks too late and staring at a 40% premium on rounds that you can't even get delivered for 2 months. Let's get into it. As of 1:45 p.m. Eastern today, silver spot was trading at $90.38, while gold was at $4,739.21. Take a moment to look at the chart from this morning. You'll notice a long upper wick that briefly reached 92.23 before moving back down to 90.38 by the afternoon. This kind of movement suggests an area of strong market interaction rather than smooth price discovery. Silver attempted to remain above the $92 level earlier today and showed momentum to move higher. However, around mid-morning New York time, increased selling activity appeared, pushing prices back below the psychologically important $90 level. This pattern has appeared repeatedly over many years and often reflects large market participants actively managing key price zones due to what may lie beyond them. Here's an important divergence worth paying attention to. While the quoted spot price sits at $90.38, reports from authorized purchasers indicate that physical premiums have risen sharply. In some cases, generic rounds are trading at roughly 1.5 times spot, when available at all. That implies a physical market price closer to $135 per ounce. The quoted price represents a reference point, while the physical market reflects real-world availability and demand. The widening gap between paper pricing and physical pricing strongly suggests underlying stress in market structure. Now let's examine the mechanism that helps explain the situation. It's called backwardation. Understanding this concept also clarifies why the US Mint's suspension of sales is not simply an operational issue, but a signal of broader market dynamics. Backwardation is a relatively uncommon condition where the price for immediate delivery exceeds the price for future delivery. In a normally functioning commodity market, future prices are higher than spot prices. This is because storage, insurance, financing, and opportunity costs all add value over time. That normal condition is known as contango. When a market shifts into backwardation, it indicates strong demand for immediate delivery. Buyers are willing to pay more to secure physical metal now, rather than wait for a futures contract to settle months later. This reflects urgency in the physical market. Consider this analogy. Imagine walking into a car dealership where the lot is empty. The dealer tells you they can deliver a vehicle in 6 months for $50,000, but someone in the parking lot is offering their vehicle today for $80,000 because there are no immediate alternatives. The premium reflects the value of immediate availability. That's backwardation. This dynamic helps explain the U.S. Mint situation. The Mint cannot source physical silver at paper market prices to meet near-term demand. While futures markets may indicate silver at $90, suppliers delivering metal on short notice may require significantly higher prices due to tight supply conditions. Absorbing that difference would make sales economically unviable. As a result, suspending sales becomes a practical response rather than a temporary technical issue. Rather than easing, current conditions suggest that physical demand pressures remain elevated. If you think the U.S. Mint is the only institution running dry, wait until you see the COMEX delivery logs. Let's talk about the math, because the numbers here don't add up. And when numbers don't add up in a fractional reserve system, that's when things break. I was looking at the COMEX data this morning, and here's what jumped out. 36.06 million ounces. That's 7,212 contracts are standing for delivery in January alone. Just in January. On Tuesday, 1.03 million ounces were moved out of the registered vaults in a single day. That's not normal. That's not even high normal. That's a bank run in slow motion. Now, zoom out. According to the UBS and Scottsdale reports that have been circulating in the industry, we're looking at a global deficit of 300 million ounces for 2026. That's the gap between what the world is demanding, industrial use, investment demand, jewelry, and what the world is actually producing from the mines and recycling. 300 million ounces short. Let me put that in perspective. Total global silver production is around 850 million ounces a year. We're short by more than a third of annual production. That gap has to get filled somehow. And the way it's been getting filled for years is by draining the vaults. The COMEX vaults, the LBMA vaults in London, the ETF inventories. Those vaults have been acting as the buffer, the release valve that kept the price from exploding every time demand spiked. But here's the problem. Those vaults are finite. And if you keep draining them at 36 million ounces a month, you hit zero a lot faster than people think. Now layer in the China factor. On January 1st, 2026, China implemented new export licensing requirements for refined silver. If you want to get silver out of China, the world's primary refining hub, you now need government approval. They've effectively turned off the tap to the West. It's not a total embargo, but it's a massive friction point that is choking off supply right when the West needs it most. So let's run the stress test. If COMEX deliveries continue at this pace, let's be conservative and say 30 million ounces a month. The registered vaults, the vaults that are actually available for delivery, could hit operational zero within weeks, not months, weeks. I want to be very clear about what operational zero means. It doesn't mean the vaults are literally empty. It means the vaults have dropped below the threshold where the market has confidence that deliveries can be made in an orderly fashion. Once you cross that line, you get a stampede. Everyone who was waiting patiently for their futures contract to settle suddenly wants out now, and the whole system locks up. The math says the system is insolvent. The skeptics say we're dreaming. Let's see who's right. We're about 60% of the way through this. So let me give you a checkpoint recap because I want to steal them in the other side before we go further. Here's what we know so far. The U.S. Mint has stopped sales. Backwardation has set in. The physical premium overspot is screaming that people want metal now, not later. 36 million ounces are being yanked off the COMEX in January alone. The vaults are draining, but there is a counter-argument, and I need to address it because if I don't, you're going to hear it somewhere else and wonder if I'm just cherry-picking data. The skeptic argument is demand destruction. The idea is that at $90 an ounce, industrial users are going to stop using silver. Solar panel manufacturers are going to substitute in cheaper materials. Electronics companies are going to redesign their products to use less silver or find alternatives. And on the supply side, at $90, every grandmother in America is going to start melting down the family silverware and flooding the market with scrap, which will crash the price back down to $60. It is a seductive argument because it's happened before in other commodities. When oil hit $140 a barrel in 2008, demand collapsed. People stopped driving as much, airlines went bankrupt, the price crashed. So let me tell you why that argument doesn't hold water here. First, industrial substitution in silver takes years, not days. If you're a solar panel manufacturer and your entire production line is built around silver paste for the conductive layer, you can't just flip a switch and start using copper-coated alternatives. You have to re-engineer the product. You have to retool the factory. You have to run new quality tests and get new certifications. That process takes 18 months minimum, and that's if you start today. The price spike we're seeing right now is not going to trigger that substitution fast enough to matter. Second, scrap supply. Yes, at $90 an ounce, you're going to see more scrap come to market. People are going to dig through their attics and sell off the silver candlesticks. But here's the thing about scrap. You can only sell it once. You can't melt down the family silver twice. Scrap is a one-time injection of supply, and it gets absorbed by the market in a matter of weeks. It doesn't solve a 300 million ounce structural deficit. And here's the part that the skeptics always miss. $90 an ounce is not too expensive in any historical context. If you adjust the 1980 silver peak for inflation, silver would need to be over $200 an ounce just to match that high. We're not even halfway there. The idea that $90 is some kind of nosebleed level that's going to trigger a collapse is a psychological anchor that does not have any basis in the actual supply-demand fundamentals. The skeptics are betting on a slow bleed. They're betting that the market will calm down, that premiums will compress, that the mint will resume sales in a few weeks, and everyone will forget this ever happened. The data is suggesting something very different. The data is suggesting a vertical explosion. So what happens next? Let me walk you through the institutional reaction and the key indicators I am watching over the next 48 to 72 hours. First, expect the CME, the Chicago Mercantile Exchange, which runs the COMEX, to hike margin requirements by 25% or more this week. This is their standard playbook. When volatility spikes, they raise the margin requirement, which means if you're holding a long futures position, you suddenly need to post more cash as collateral. This forces weak hands out of their positions. It's a way to cool down the market and reduce the number of contracts standing for delivery. I've seen this movie before. In 2011, when silver ran to $48, the CME hiked margins 5 times in 2 weeks. It worked. The price got cut in half. So if you see margin hikes announced, don't panic. It's part of the game. They're trying to shake the tree and get you to drop your silver. Second, watch for a media blackout on the LBMA London situation. I've been hearing whispers for the last week about potential issues with unallocated silver in the London vaults. Unallocated means you own a claim on silver, but there's no specific bar with your name on it sitting in a vault. It's fractional reserve bullion banking. And if the rumors are true, the LBMA might be getting close to a point where they won't honor physical delivery requests on unallocated accounts. If that happens, if London switches to cash settlement only, that's the decoupling event. That's when the paper market and the physical market officially split into 2 different universes. Here's my dashboard. These are the 3 things I'm watching obsessively. Number 1, LBMA vault data. The London Bullion Market Association publishes vault inventory numbers. If unallocated silver holdings drop another 10% from current levels, that's the canary in the coal mine. It means the fractional reserve ratio is breaking down, and they are scrambling to source physical metal to back up the paper claims. If London switches to cash settlement only, here's what that looks like in practice. You call up your broker and say, I want to take delivery of my 10,000 ounces of silver. And they say, sorry, we can't do that, but we'll pay you the cash equivalent at the current spot price. Except the spot price is $90 and the actual physical market is trading at $130. You just got robbed of $40 an ounce. And it's perfectly legal because you signed a contract that allowed for cash settlement in the event of force majeure. That's the nightmare scenario for anyone holding paper silver. ETFs, unallocated accounts, futures contracts that you don't roll into physical delivery. All of it becomes monopoly money the second the LBMA or the COMEX says, we're out. Here's your cash. Good luck finding real metal. And here's the kicker. When the paper price crashes, because everyone realizes it's worthless, but you still can't buy a physical coin for less than $100 an ounce, that's when you'll know the game is over. That's when the market has openly admitted that the emperor has no clothes, that the vaults were always running on fumes, and that the price suppression scheme has finally run out of road. So, let me tell you exactly what I'm doing with my own capital. I need to say this up front. I am not a financial advisor. I'm not your financial advisor. I'm a guy who's been watching these markets for 12 years, and I'm watching the vaults empty in real time. What I'm about to share is my personal battle plan, and you need to do your own research and make your own decisions. Here are my indicators and my conditional strategies. First, I'm watching the 9150 level like a hawk. If silver holds above $91.50s for 3 consecutive daily closes, I'm interpreting that as breakout confirmation. At that point, the technical picture flips from fragile rally to sustained move higher. In that scenario, I'm looking to add exposure, but not through physical. Physical premiums right now are too predatory. I'm not paying a 50% premium when I can get leveraged exposure through the miners. Specifically, I'm looking at SILJ, the Junior Silver Miners ETF. When physical silver is in backwardation and the miners are still trading at reasonable valuations, that's where the asymmetry is. The miners give you operational leverage to the silver price without the premium gouging and the 2-month delivery wait times. But here's the critical qualifier. I'm only adding to miner if we get confirmation. If silver fails at 91.50 and rolls over, I'm sitting on my hands. I've been in this market long enough to know that failed breakouts are traps, and I'm not interested in catching a falling knife. Second scenario, the US Mint resumes sales, but the price tag is $120 or higher per Silver Eagle. If that happens, I'm interpreting that as the new permanent floor. It means the Mint has openly admitted that the old pricing model is dead, that the spot price is irrelevant, and that the physical market is now setting the price based on actual supply and demand. In that scenario, I'm not selling a single ounce of my physical stack. In fact, I'm holding tighter because if the sovereign mint is pricing at 120, that tells me the private market is going to be even higher. It means we're in a regime where physical silver becomes a strategic asset, not just a speculation. Third scenario, the CME raises margins drastically. Let's say they double the margin requirement overnight. Here's what I'm doing in that scenario. Absolutely nothing. I'm sitting on my hands. I've seen this playbook in 2011. They raise margins to force liquidation. The price drops 20 to 30% in a week. As leverage longs get margin called out of their positions, and then once the weak hands are flushed out, the price resumes its climb. If we get that margin-induced sell-off, I'm treating it as a gift. I'm waiting for the panic bottom, and then I'm buying more probably through the miners again, because the margin hikes don't affect equity positions, only futures positions. So while the futures traders are getting slaughtered, I can step in and pick up miners at a discount. The thing about margin hikes is that they create artificial selling pressure. It's not real supply coming to market. It's not mines producing more silver. It's not scrap flooding in from the secondary market. It's just forced liquidation from traders who can't meet the new collateral requirements. That kind of selling gets absorbed quickly. And when the dust settles, the underlying supply-demand picture hasn't changed at all. The deficit is still 300 million ounces. The vaults are still draining. The mint is still dark. So if I see silver drop from a 92 to 70 on a margin hike, I'm not panicking. I'm getting aggressive. That's the moment when everyone else is running for the exits, and I am walking in through the back door. Fourth scenario, and this is the big one. The LBMA confirms a physical delivery freeze. If London officially announces that they can't honor physical deliveries on unallocated accounts and they are switching to cash settlement, I'm moving entirely to self-custody and ignoring the ticker tape. Here's what that means in practice. I'm pulling everything out of ETFs, out of allocated storage programs, out of anything that has a custodian or a middleman. I'm taking possession. I'm treating silver like a crisis hedge, not a trading vehicle, because at that point, the paper market is officially dead. And the only thing that matters is what you can hold in your hand or lock in a safe. And I'm ignoring the price. If the spot price says $70 because the paper market collapsed, but I can't actually buy a coin for less than 150, then the spot price is meaningless. It's a distraction. The only price that matters is the price I'd have to pay to replace my stack. And if I can't replace it at any price because there's no supply, then my stack just became priceless. Let me tell you why the LBMA situation is the keystone here. London is the nerve center of the global precious metals market. More gold and silver trades through London than anywhere else on Earth. The LBMA vaults are the backstop for the entire Western bullion banking system. When a bank in New York wants to hedge a position, when a pension fund in Germany wants exposure to precious metals, when a refiner in Switzerland needs to balance their books, it all flows through London. If London breaks, the entire architecture collapses. Because once the LBMA admits they can't deliver physical metal, every other institution in the chain starts asking the hard questions. If London can't deliver, can the comics? If the comics can't deliver, can the ETFs? If the ETFs can't deliver, what exactly am I holding? That's the cascade. That's the moment when confidence evaporates, and everyone rushes for the exits at the same time. And in a fractional reserve system, there aren't enough exits. Most people are going to get stuck inside when they lock the doors. Now, let me talk about the psychological trap that I see retail investors falling into right now, because I want to make sure you don't get caught in it. The trap is waiting for the mainstream media to confirm the squeeze before you act. The trap is thinking, well, if this is really as big as he's saying, CNBC will cover it, and then I'll buy. That's backward. By the time CNBC is running a special segment on the silver squeeze, the premiums will be 3 times spot, and you won't be able to get delivery for 6 months. The reason I built this channel is because the mainstream financial media is structurally designed to be late. They're not trying to give you actionable intel. They're trying to explain what already happened. I saw the Mint website go dark yesterday afternoon. I got the leaked distributor email last night. I checked the comics delivery data this morning. I'm telling you about it now, a few hours later. If you wait for Bloomberg to write a long form article about it next week, you've already missed the move. The other trap is paralysis. The trap of thinking, well, the situation is so complex when there are so many variables, so I'm just going to wait and see what happens. I understand that instinct. I really do. The problem is that in a squeeze, waiting and seeing is the same thing as getting priced out. If you're on the fence about building a position in physical silver or the miners, and you decide to wait another month to see how it plays out, you might come back in a month and find that the price is 40% higher and the premiums have doubled. I'm not telling you to go all in today. I'm not telling you to back up the truck and buy a 0.00 ounces at a 50% premium. What I'm telling you is to have a plan. Know your entry points. Know your risk tolerance. Know what indicators you're watching. And when those indicators trigger, act decisively. For me, the indicator is 9,150 for 3 consecutive closes. If we get that, I'm adding to miners. If we don't, I'm waiting. But I've already made the decision in advance. So when the moment comes, I'm not sitting there paralyzed trying to figure out what to do. Let me give you one more conditional scenario because I think this one is underpriced by the market right now. If, and this is a big if we see a coordinated announcement from multiple sovereign mints in the next week, not just the US Mint, but also the Royal Canadian Mint, the Perth Mint in Australia, maybe the Austrian Mint, if they all suspend sales, citing supply issues, that's a 5-alarm fire. That's the market openly admitting that the entire Western minting infrastructure can't source metal. In that scenario, I'm immediately moving 20% of my liquid net worth into physical silver and miners, regardless of premium. Because at that point, it's not about getting a good entry price. It's about getting in at all. It's about positioning before the market realizes that this isn't a temporary blip. It's a structural break. And here's the thing. I don't think that scenario is unlikely. I think it's probable. The US Mint doesn't operate in a vacuum. They're all sourcing from the same global supply chain. If the US Mint can't get planes, the Canadian Mint is facing the same problem. It's only a matter of time before they all go dark. The Perth Mint specifically is worth watching because they've had credibility issues before. Back in 2021, there were reports that they were running low on allocated silver and delaying deliveries. They denied it publicly, but the wait times told the real story. If Perth goes dark again, that's confirmation that the problem is global, not just a US supply chain issue. Now, let me address something I know some of you are thinking. You're thinking, okay, but what if this is all a false alarm? What if the Mint resumes sales next week and the price drops back to $70 and you look like an idiot? I'm not buying silver on margin. I'm not selling naked puts. I'm not doing anything that could blow up my account if I'm wrong. If I'm wrong and the price drops, I lose on paper, but I don't get margin called. I don't get liquidated, and I can wait it out. Second, I'm not making this a binary bet. I'm not going 100% into silver and ignoring everything else. I still have exposure to equities, to real estate, to cash. Silver is a piece of the puzzle, not the whole puzzle. So if I'm wrong, it doesn't wipe me out. Third, I have a time horizon. I'm not trying to trade this week to week. I'm positioning for a multi-month or even multi-year move. If the price chops around for the next 3 months before it eventually breaks out, I'm fine with that. I'm not expecting this to resolve in 72 hours. I'm expecting this to be a process. But here's what I keep coming back to the asymmetry. If I'm wrong, I lose maybe 20 or 30% on my silver positions before I cut them. If I'm right, we're talking about a 200 to 300% move over the next year. The risk reward is heavily skewed in favor of being positioned, even if there's a decent chance I'm early or partially wrong. Now let me be honest about something else. I've been early before. In 2019, I started accumulating silver at $16 an ounce because I saw the industrial deficit building and the monetary policy tailwinds aligning. For 18 months, I watched my positions go sideways and then down as the price dropped to 14 in early 2020. I looked like an idiot, and then COVID hit. The fiscal floodgates opened and silver went from $14 to $30 in 4 months. Being early feels the same as being wrong until it doesn't. The difference is that if you have conviction based on fundamentals and you're managing your risk properly, you can afford to be early. You can't afford to be late. Let me also talk about the end game because I think it's important to have a mental model of where this goes if the squeeze thesis plays out. Endgame scenario 1, the paper market capitulates. The COMEX and the LBMA both switch to cash settlement. The futures price crashes to $60 or $70 because nobody trusts paper anymore. But the physical market decouples entirely and trades at $150 to $200 based on actual supply and demand. In that scenario, if you're holding physical, you're fine. You ignore the paper price. You wait for the physical market to stabilize. If you're holding ETFs or futures, you get destroyed. This is the nightmare scenario for the bullion banks, by the way, because they've been running this fractional reserve game for so long that they have forgotten what happens when people call their bluff. They've built an entire derivatives tower on the assumption that 99% of futures contracts will get rolled or cash settled and nobody will ever actually ask for the metal. When that assumption breaks, when people start standing for delivery en masse, the whole structure comes down. Endgame scenario 2, the short squeeze. The bullion banks who have been shorting silver for decades get caught in a delivery squeeze. They can't source the metal to cover their positions. They're forced to buy back their shorts at whatever price they can get. The price goes vertical. We're talking a move from $90 to $200 in a matter of weeks. In that scenario, the miners go absolutely parabolic, and anyone positioned in the space makes generational wealth. I've seen glimpses of this before. In 2011, silver went from $30 to $48 in less than a month. It was not a squeeze, it was a momentum rally, but it showed you what this market can do when it gets moving. A real squeeze, where the shorts are trapped and have no choice but to cover, would make that 2011 move look tame. Endgame scenario 3, the slow grind. The mint resumes sales at elevated prices. The LBMA muddles through. The price chops between 80 and 110 for the next 6 months, while the market slowly realizes that the deficit is real and the vaults are not being refilled. In that scenario, it's not a dramatic explosion. It's a grinding bull market that takes a year to play out. Still profitable if you're positioned, just less exciting. This is actually the most likely scenario in my view. Markets don't usually resolve themselves overnight. What you get instead is a series of mini crises that slowly shift the consensus. The mint stays dark for 3 weeks. Then they come back, but with rationing, 2 coins per customer, elevated prices, long wait times. Then Perth announces delays. Then the LBMA quietly raises their allocated storage fees. Each event by itself is explainable, but when you string them together, the pattern becomes undeniable. I don't know which endgame we're heading toward. I suspect it is some combination of 2 and 3 where we get a short squeeze spike, followed by a consolidation, and then a grinding move higher. But the key point is that in all 3 scenarios, being positioned in physical or miners is the right trade. The only losing scenario is staying in paper and getting cash settled out of your position. Here's another thing I'm watching that doesn't get enough attention. Industrial users. Companies like First Solar, SunPower, all the solar panel manufacturers who use massive amounts of silver for their photovoltaic cells. These companies hedge their silver exposure months or even years in advance through futures contracts. But if the futures market breaks, if the COMEX can't deliver, these companies are going to have to go into the spot market and compete for physical metal. When that happens, you're going to see industrial users bidding against investment demand, and that's when the price really takes off. Because an investor can choose to sit on the sidelines if the price gets too high. But a solar panel manufacturer who has a billion-dollar backlog of orders in a factory sitting idle because they can't get silver, they'll pay whatever it takes. That's the demand inelasticity that the market is underestimating. Industrial silver demand doesn't disappear at $90 or $120. It adjusts slowly over years. As companies redesign products, in the short term they have no choice but to pay up. Let me also address the geopolitical angle here, because it ties directly into the China export restrictions I mentioned earlier. China controls about 40% of global silver refining capacity. They're not a major producer. Most of the ore comes from Mexico, Peru, and Chile, but the ore has to be refined, and most of it gets refined in China. On January 1st, they put in place new licensing requirements that effectively give the Chinese government veto power over any silver exports. Why would they do that? Because they're watching the same data we are. They see the deficit, they see the COMEX draining, they see the West scrambling for metal, and they have decided they'd rather keep the silver inside China for their own industrial base and their own strategic reserves than let it flow west to prop up the COMEX and the LBMA. This is economic warfare playing out in slow motion. It's not dramatic. There's no missiles, no sanctions. It's just a licensing requirement. But the effect is the same, choking off supply to your competitors at the exact moment they need it most. And here's the kicker. There's no quick fix. You can't just build a new refinery in Ohio and start processing ore next month. Refining infrastructure takes years to build and requires environmental permits, skilled labor, and capital investment. In the short term, the West is dependent on China for refined silver, and China knows it. So when I'm positioning for this squeeze, I'm not just thinking about the immediate supply-demand dynamics. I'm thinking about the geopolitical chess game that's playing out in the background. If China decides to tighten the screws even further, maybe they announce an outright export ban on refined silver, the price could gap up 50% overnight. That's tail risk that's not priced into the current market. All right, let's bring this home. Here's the recap. The US Mint has suspended all silver sales. The buy now buttons are gone. The official explanation is market volatility. The real explanation is they can't source the metal at a price that makes sense. COMEX is facing a 36 million ounce delivery wave in January alone. The vaults are draining. We're looking at a 300 million ounce global deficit for the year. Backwardation has set in, which means the market is screaming for immediate delivery and the normal market structure has inverted. China has turned off the export tap with new licensing requirements. The LBMA in London is rumored to be in trouble with unallocated accounts. The physical premium over spot has blown out to 50% or more if you can even find metal. The paper price says $90. The physical market says $135. That spread is the crack in the dam. Here's my final rallying cry, and I want you to really hear this. The paper wall is cracking. For decades, they told us there was plenty of silver. They told us the vaults were full. They told us that the price was set by supply and demand in a free market. Yesterday, the US Mint admitted they were wrong. They didn't say it explicitly, but the dark website said it for them. The metal is gone. Don't wait for the mainstream media to tell you the squeeze is here. It's already through the front door. It's already in the comics vaults. It's already showing up in the premiums at your local coin shop. Within the next 48 hours, we're going to see if the LBMA follows suit. We're going to see if London confirms what everyone in the physical market already knows. The fractional reserve bullion system is out of metal. If you've been sitting on the fence, now is the time to make a decision. Not tomorrow, not next week, now. Because the situation is moving faster than the news cycle. And by the time the headlines catch up, the opportunity will be gone. I'm watching 91150. I'm watching the LBMA vault data. I'm watching the premium spreads. I'm watching the miners for value. And when my indicators trigger, I'm acting. I've already made my plan. I know what I'm buying. I know at what price. And I know what my exit looks like if I'm wrong. You need to have that same level of clarity. Because in a squeeze, hesitation is the same thing as capitulation. This isn't financial advice. This is a guy who has been in the trenches for 12 years, telling you what he sees and what he is doing about it. Take it or leave it, but don't say you weren't warned. One last thing. I know some of you are going to watch this video and do nothing. You're going to think about it. You're going to agree with the thesis. And then you're going to get distracted by life and forget about it. And then in 3 months, you're going to see silver at $160, and you're going to kick yourself for not acting when you had the chance. Don't be that person. If you believe the thesis, position accordingly. Even if it's just a small position, even if it's just 10% of your portfolio, do something. Because the regret of missing an opportunity is worse than the regret of taking a small loss. The deep research on the London situation is already up on the channel. Go watch it. Understand what happens if the LBMA breaks tonight and then make your plan. Thanks for watching. I'll see you in the next one.